Greetings, students, once again. This is a question on the topic of weighted average cost of capital, and is question to the fast and the furious question out of 20 marks. And it's not always the time, or it will not always be the case that in the assessment they will clearly tell you that this is weighted average cost of capital. You might need to be able to identify or to know now that you must use weighted average cost of capital. It says Fast and Furious Transport Pty Ltd is a transport company that specializes in transport of retail products for retailers. The following is the extract from the statement of financial position at 31st of December in the year 2013. So we are given this extract from the statement of financial position. And just having a look, we have our equity, we have our liabilities, which are made of non-current and current. And if you take note, we have a loan, debentures, preference shares, deferred tax, and I think the major one will be the long-term loan, the debenture, and the preference shares. Deferred tax will likely not be useful in our calculations. Then below that, it says that we have trade and other payables and SARS, which is tax that is due to SARS, or we owe to SARS. Then we have additional information that is given to us, and it says 1 million ordinary shares are in issue and are currently trading at a market value of 400 Rand each. So that is the market value of these ordinary shares. And we are already told that these shares are given to us as a total of an amount of 1 million. Take note of that. It is 1 million ordinary shares. Then after, we are told that the cost of equity, it is 20% for these ordinary shares. Then we proceed to the next one, which is preference shares, which have no conversion rights and carry a dividend payout of 11%, while similar preference shares are currently trading at 10%. Now, the minute they give us 20, or the minute they give us 11%, remember, we are given in the extract of the statement of financial position that we have our preference share capital of 25,000. I will just use the figures as they are recorded, not to include the millions. So meaning 11% of this amount will be what we call preference dividends, meaning dividends that are paid by this company to the preference shareholders at the agreed 11%, which is the rate that these preferences were bought at. Then after, we have the similar preferences that are currently trading at 10%, meaning according to the market, other similar preferences, they are currently trading at 10%, not at 11%, as we agreed with these preference shareholders when the preference shares were issued. Then after, it says, I will explain all of that, but let me just do a calculation regarding this preference dividends. We have 25,000 times this by 11%. Therefore, now it means we'll have 2,750 of the preference dividends. And these are the preference dividends based at the 10%, which is the rate at which these preference shares were bought at. Then after, we proceed, and it says the debentures mature in 5 years. 5 years becomes our N. Take note of that. They mature in 5 years' time at a premium of 10%. Remember, a premium is the amount that is added to the capital when the debentures are redeemed, or when the debentures are bought back from the debenture holder. Remember, if you look in the financial statements, we have debentures of 15,000 rands, meaning for us to have this 15,000, someone must have bought debentures in our company that were on sale, and that person bought debentures and invested 15,000, and the agreed rate, that was 15,000 of the debentures that were bought, and now we have the premium of 10%. The agreed rate that when these debentures are bought back from the debenture holder, we have to add 10%. So meaning when they are redeemed in the next 5 years, when we give them back or buy them back from the debenture holder, we'll have to give the debenture holder the 15,000 plus the 10%. So that's what a premium is to say the capital is given back plus the interest, which in this case is the premium of 10%. So meaning in the next 5 years, once again, we have to pay the debenture holder 15,000 plus 10% of 15,000. So now if you say 15,000, term that by 10% is 1.5, meaning it will be 15,000 that will be paid in 5 years time plus 1,500. So the total that will be paid will be 16,500 rands. So this is the amount that will be paid to the debenture holder at the end of the 5 years period, which is the maturity of these debentures. Then after it says the debentures carry an interest rate of 12.5%. So now meaning each and every year in the next 5 years, each and every year we have to pay the debenture holder 12.5%, because when the debenture holder invested money in our company in the form of debentures, we agreed that we are going to give this debenture holder 12.5% of the capital that he invested. So now meaning 12.5% will be an annual payment that we pay to our debenture holder at 12.5 times that by the capital the debenture holder had invested. So now meaning this will be, when we speak of the calculator now, HP or sharp, be what we call PMT. Remember, the 16,500 is the amount that will be paid after 5 years when the debentures are redeemed, or when the debentures mature in 5 years. So this is the future value, the amount that will be paid in the future. Sorry to go back to this one. This is the future value. But each and every year we have to pay the debenture holder 12.5% out of the capital that he invested, meaning in that 15,000 we have to say term this by 12.5, and it gives us 1,875. This is the amount that we will be paying to the debenture holder every end of the year, because this is the rate we agreed of interest that will be paid to the debenture holder. So now on that same note, proceed. It says now similar debentures are trading at 11.11%, and this is before tax. Take note, remember, debentures or a payment of this amount, the 1,187, is more of an interest, because we as a company, we borrowed money from the debentures in the form of a debenture, and that money was 15,000. So now if we borrow money from the debenture holders, we expect that we must give them interest because they invested in our company, and they invested 15,000 rand. So we have to give them the interest on their investment. So the interest on their investment, which is 1,875, is an interest expense on our side. So now hence we also have to take into account, they say before tax, we have to take into account the tax part when it comes to the interest. Now I'll come back to that later. Remember, this is similar debentures are trading, so this is the market rate. This is the market rate. And previously, when it comes to the preference shares, we had preference shares that were paid at 11%, but similar preference shares were trading at 10%. So this is the market rate, and this is also the market rate in terms of the interest rate. So now we will be dependent on the question. If the question wants us to calculate weighted average cost of capital based on these market rates, therefore now I'll consider the market rates. I don't want to consider them now unless the question states that, but I know it really states that. Therefore now we have that PMT. Then we go to the next bullet point. It says the long-term loan matures in 8 years' time, and it carries an interest of 15%. The current long-term interest rate for a similar loan is 16.67. It is 16.67. Where there is maturity, we have to use the calculator. It matures in 8 years. The debentures, they said they mature in 5 years. So where there is maturity, you have to use a financial calculator to calculate the present value of that financial instrument. Meaning, again, in the debentures here, we need to calculate the present value of the debenture as a financial instrument. And together with this loan, we need to calculate the present value of this loan, which will mature in 8 years' time. And the interest that we pay to this loan, remember we had this long-term loan. There was a long-term loan of 89,195. We have to pay interest of 15% as we agreed with the bank. And interest is paid every year. This is 89,156, times that by 0.15. So now if this is the case, it means an amount of 13,373.40 must be taken into account as an interest. Now, let me just chip something else now that I've not yet explained. Interest is recorded in the statement of profit and loss. So now meaning we will be allowed to deduct this amount. So there will be tax implications when it comes to interest. So similarly with the debentures that were maturing in the next 5 years, and this is interest in the form of debentures. So now if this is interest, it will go to profit and loss. So now there will be tax implication when it comes to this interest. So now we need to take into account the interest after tax has been taken into account, because there will be or likely to be some tax implications. I'll come back. I'm just explaining some few things. So now this preference, this PMT for the debentures 1875 is before interest, and also this 13,373.40 is before interest. Sorry, it's before tax. In fact, not interest, is before tax. So now we still have to take into account tax, but we don't know if there is tax yet or not. So the loan is at 15%, and the current long-term interest for a similar loan is 16.67. So this is the market rate of the loan, and this is the rate that we agree, or the coupon rate that we agree to pay to the bank. But other loans, they have interest of 16.67. Then now let us go to the next part. And the next part now, it is the creditors. They telling us something about creditors. They say the creditors are normally paid in full within the normal credit period without any interest being paid or discount received. Short-term credit is not paid of the long-term financial structure for the company. And they tell us that the bank overdraft bears interest at 18% per annum, and the current tax rate is 20. Therefore, now there's a tax rate. The minute there's a tax rate, therefore now we need to take the tax rate into account, meaning our interest must be after the tax has been taken into account, and also our rates must be after the interest has been taken in account. But that is with exception with the dividends, because dividends, they don't affect tax. In terms of tax at 28%, dividends, they do have the 20% interest, 20% tax. I don't want to mislead you on that. but dividends, they don't affect the statement of profit and loss, meaning income statement. So this 28% will only affect the long-term loan and the debentures, because these are the interests, not dividends. So now we have to take into account that 28% of tax, so that our interest that we calculated here must be after tax. We need to calculate that interest after tax. And also with regard to the debentures that were trading, or that carry 12.5, we need to take into account the after tax implication, meaning after we have deducted 28%, because we are allowed to deduct interest in the statement of profit and loss. So now that must also be deducted in our interest. Now let me go to the requirements. Then we see what we are required. It says calculate the weighted average cost of capital, which is WACC, based on the current capital structure for the year 2013, based on the market values. Meaning the capital structure must not change, it must remain the same, but it should be based on the market values. So now market values, remember, with regards to the loan, this was the market value. With regard to the debenture, this was the market rate. And with regard to the preference dividends, this was the market rate. So we need to be mindful of all these rates that we have taken into consideration. Now, let me start now doing the real calculations. Let us start with the first source of financial structure or finance structure, which is the 400 of the ordinary preference shares that were issued a long time, and there were 1 million of them. They are already given to us. So now with that, we need to just calculate our ordinary capital according to the market values. Take note of the fact that we are given, or we are told that 1 million shares, ordinary shares, were issued and at a market value, and they are currently trading at a market value of 400 each, and the cost of equity is 20%. So now that means the market rate or market value is 400. So when we take the market rate, we multiply by the 1 million shares, that will give us the ordinary share capital according to the market values. So now let us do the ordinary capital. We start with the ordinary share capital, and for this one is very straightforward. We have 1 million ordinary shares that were issued or that are in issue. We multiply this by 400, then we will see how much do we get. 400 times this by 1 million, then this gives us 400 million. This gives us 400 million. 400 million. Then we are done with the first source of fund or first financial instrument, which is our ordinary share capital. Then we go to the second one, and the second one, it is the preference shares. Remember, we need to calculate them using the market values. It said that the preference shares have no conversion rights and carry a dividends payout of 11%, and similar preference shares are currently trading at 10%. So now we first need to know how much will be our preference dividends according to the agreed coupon rate. Then after, we convert our preference stated capital according to the market values. Then now let us go to number 2, which is our preference capital or preference stated capital. We have our preference capital, then we have to calculate our preference dividends first. Our preference dividends, and our preference dividends are based at the rate, and let us look for the preference stated capital. Our preference stated capital is 25 million. I have to take into account all the zeros because my ordinary, I took into account all the zeros for the millions. So now it's 25 million times this by the percentage of the preference shares, which is 11%. There we have our preference payout of the shares at 11%. That is the amount that we pay. So now we have 25 million, and 25 million times this by 11%, and we will see what do we have. 25 million times this by 11%. So this gives us 27 million, or 2,750,000. 2,750,000. So now this is our preference dividends that are paid at the payout rate of 11%, because the preference dividends are, or preference shareholders are paid at 11% of the amount that was invested. So we have calculated our preference, which is 2,750,000 rands. Therefore, now it is stated that similar preference shares are currently trading at 10%. So now we have to say how much can be the market preference share capital if the dividends are paid at 10%. That's more of responding to that question, because we know that if the preference dividends or preference shareholders are paid at 11%, our preference stated capital is 25 million. But now if we have our dividends, which we have calculated as 2,750,000, how much then will be the new preference capital according to the market? So that's what we will be doing now. So now we are calculating market preference capital. Market preference capital, or the capital according to the market. So now we say we already have 2,750,000 rands, and we say if these are the dividends that are paid, how much was supposed to be the capital based on the market? So hence we divide this by 0.10, which is 10% in other words. So we are working backwards and say now that preference shareholders are paid 2,750,000, how much will be the capital according to the market if the market pays the same preference shareholders at 10%. So now hence we just divide the preference dividends by 10% to get to the capital, meaning the preference capital according to the market. Remember, according to us, the preference share capital is 25 million. But now according to the market, it will be a bit different. So we divide this by 0.10, then we get 2,750,000 rands. 2,750,000 rands. Not 27,500,000 rands. Yes, 27,500,000 rands. So now this is our capital according to the market. This is the market capital. Preference shares according to the market rate of 10%. So now this is how you normally do the conversion. Remember, let me just go a little bit from a very similar approach. We already have our preference share, our preference dividends of 2,750,000. So now we know in order for us to go back and calculate our preference capital, which we know according to the business, it will be divide this by 11%. If you divide this by 11%, it will give you the same 25 million. But we are not looking for the capital according to the business or the normal rate that they agree to the preference shareholders, but we are looking for the capital according to the market, and the market is paying the similar dividends at 10%. So hence we divide it by 10%. So now let us go to the next one. So this will be our preference share capital according to the market. Then we go to the third financial instrument. The third financial instrument. And the third financial instrument, it is the debentures that mature. The debentures that mature. And let me just emphasize on this before I close. Remember, preference dividends do not attract tax of 28%. So now we don't take into account the tax, because dividends, they don't go to the statement of profit and loss. They only attract their tax of 20%, not the 28% rate of tax. So now we come to the debentures, and it says the debentures mature in 5 years' time at a premium of 10%. And then after it says the debentures carry an interest rate of 12.5%. Remember, I explained the premium is what will be paid at the end of 5 years. Above the capital, we have to add 10% in that capital. So now if there is a premium of 10%, therefore now, meaning under our debentures, which is the third financial instrument, under our debentures, we need to know the, first of all, our N. Our N is 5 because the debentures mature in 5 years. Then after, we know that there will be a future value, which will be plus or minus. And let us confirm how much will be the future value. Remember, at the end of 5 years, we have to pay our debentures the full amount of 15 million plus 10% of that, because a premium is to add on the capital the premium that we have agreed. So the premium is the addition above the capital. So now the 10% of the premium is the amount that will be paid in 5 years, meaning above that 15 million, we have to add 10%. So now let us check how much will be the total amount to be paid in 5 years' time. So that will be a total of 15 million. 15 million times 1.10. So we are just adding 10%. It will be 15 million. Multiply this by 1.1. It gives us 16,500,000 rands. 16,500,000 rands. This is what the company will pay in the future. So now the company will pay that in the future. Then we also need to know how much will the company pay every year, PMT, plus or minus. Remember, your future value and your PMT, they go together. If your future value is PMT, your future value is plus minus, your PMT must also be plus or minus. So now we know that the company will pay a total of PMT to the debenture holders at the rate which is given as 12.5%. That's what the company will do, because they agreed to pay this interest to the debenture holder every end of the year. The debentures carry an interest of 12.5%. So every end of the year, we have to pay these debenture holders 12.5% of the capital that they invested. Remember, they invested 15 million. And in that 15 million, 12.5% must be an interest, 0.125. So now meaning 187,000 or 1,875,000 must be an interest that the company pay per annum to the debenture holders. But remember, interest is attracting tax. So now meaning it will be allowed for us to deduct our interest in the income statement so that we pay less tax to SARS. So now if we pay less tax to SARS, so it means this interest must be after 28% of tax has been removed, because that 28% of tax will not be paid. So this 28% of tax. So now hence our PMT must be after tax in the case of a debenture or a loan. So now we have to times this by 72%, or else if you want, you can say minus 28%. That's what we are doing. We are deducting 28%. Remember, we have 100% minus 28%. This is 72%. So that is why we just multiply by 72%, because 100% minus 28% gives us the remainder of 72%, meaning after tax has been, or tax of 28% has been taken into account. So hence we just multiply this by 72%. So we have 1,875,000 times this by 72%. We have in brackets 1,875,000 times this by 72%, and we check how much do we have times this by 0.72. It gives us an amount of 1,350,000 rands. So this is the interest that will be paid to our debenture holders. But this is after the tax implication has been considered, because we pay the 1,875,000 to our debenture holders, but SARS will allow us a deduction of 28%. So according to us, we are not paying the full amount. There's a benefit of tax from SARS. So hence we deduct that 28% and we record only the 1,350,000 rands. Then after now, we have to look for another factor, which is our interest. Remember, we are looking for, what are we looking for? We are looking for the present value. That is our main focus. We are looking for the present value of this financial instrument. If in the next 5 years, we will be paying this amount to the debenture holders, and every year we will be paying the amount of 1,875,000, and after tax effect it will be 1,350,000, and this is in 5 years, and there will be interest. And remember, we want to know the present value of the financial instrument according to the market values. Don't forget, according to the market values, based on market values. So now it means our interest must be the interest of the market, not our interest. But take note that when it comes to future value, there's no market value for that. Our PMT, that's what we are paying. So we cannot change our PMT. We only change the interest, and we take the interest of the market. And it must also be after tax, because we are dealing with a financial instrument that is affected by tax very positively. So now these debentures are currently trading at 11.11%. This is the trading rate according to the market, and this is before tax, and we need it after tax has been taken into account, because this interest must be deducted of 28% of the tax that we have spoken about. So 11.11% must be after tax. So now let me then again open brackets and say 11.11 times here by 72%. I think now you understand why I multiply by 72%. If you want, you can just say minus 28%. So we have 11.11 times this by 72%, and this gives us 7.9992, which can be just said as 8%. That will be fine, because 7.99. So I will keep it as 8%. And remember, once again, I am using sharp calculator. I want to emphasize on that. So my workings are based on the sharp calculator, because it is really sharp. So I'm using a sharp calculator. So my calculations are based on Sharp. If you are using HP, stick to the ways of doing the calculating present value in your HP calculator. So now I have my N, which is 5, is my N. 1 million or 16,500,000, which is plus or minus future value. And I have plus or minus 1,250,000, which is my PMT. Then I have 8, which is my interest. Then I am looking for the present value. So now my present value will be an amount of 16 million. So let us record that immediately, which is our PV. Our present value is an amount of 16 million. I get 16,619,781 rands. So that's what I get as my PV. Let me just recalculate that for those who are not sure. We have our N, which is 5 is N, and our 8 is the interest. Then we have 16,500,000 rands, and that is plus minus future value, and plus minus 1,350,000 rands, and this is my PMT. Then after I compute my present value, it is 60,619,781, and it says 81.3 in my calculator, just to put all the decimal, meaning 30 cents. So that will be the present value according to the market. So this is the amount that I was looking for. Now we go to the other financial instrument, which is a long-term loan. And the long-term loan, we know that a loan attracts interest. Don't forget, loan and debentures attract interest. They don't have to state it to you. You just have to know that. A loan is a loan, and interest on a loan affects your income statement. So there is tax implication, which is a benefit on our side, where we pay less tax because of the deduction of interest that we would have been allowed by SARS. Then it says the long-term loan matures in 8 years. Maturity date is N. So simple, straightforward. You go to your preference, capital. Your preference, capital, is good to have headings. We already know that our N is 8. The date it matures is N. So now this financial instrument will mature. Sorry, this is not preference, it's long-term loan. I don't know why I have preference. Sorry for that. So we have long-term loan. Long-term loan. Our N is 8 years. And we are told that, and it carries interest of 15%. If they are quiet, meaning the interest is before tax, unless stated otherwise. Sometimes they will need to state that, like in the previous question, they said 11.5 before tax. So we knew it was before tax. And interest on a loan is likely to be before tax. So if it's quiet, we will assume it to be before tax. And again, in that 12.5 on the previous one, they did not specify, but we knew that it was before tax. So silence means it's before tax by default. So now we have the interest of 15% on the loan, meaning on the loan that we have borrowed, and we have borrowed 89,156. So now, meaning we have to multiply that by 15% to get to the amount of interest that we pay on a monthly basis. Then here we say 89,156,000. We multiply this by 15% and we discover how much we are paying before tax. Then if we multiply this by tax, the amount that we pay ends up changing now to a different amount of 96,000. So now let me go to my calculations again. We have 89,156,000. Let me go to my workings. We are looking for PMT. How much are we paying to the bank every year? It is plus or minus. Remember, it will be times this by 0.15, and this amount will be before. It will be before we pay. It is 1,337,300. Let me confirm. 89,156,000 times 0.15. 13,373,400. 13,373,400. So this is the interest before tax. Then we have to multiply this by 72% to get to our interest after 28% of tax benefit has been deducted. Then we multiply this by 0.72%, and meaning our interest after tax will be 96,288,000 or 96,862,000 or 962,888.48. Don't know why I can't call this number very well. Or 9,628,848. Okay, it's 9 million. It's a bit big amount. So this is our interest that we pay to the bank every year. So hence it becomes PMT. So we need to know how much are we going to pay in the future. How much are we going to pay in the future? When it comes to the loan, there's no premium on the loan. I'm not mistaken. I'm looking at the debentures. Remember, debentures, we had a premium. On the loan, we just have to pay what we owe at the end of the maturity date. So now meaning this is the amount that will be paid unless there's a discount that will be given. So now meaning in the future, we have to pay the full amount. As I said to you, PMT and future value go together. If the sign of PMT is plus or minus, the sign of future value must also be plus or minus. They go together. So now it will be 89,156,000 rands that will be paid in the future. Then we need to know the interest according to the market. Why? Because we are looking for the present value of this financial instrument being a loan presently if the interest was the current trading market interest. After tax, don't forget that. So now the current trading market rate, it is 16.67%. Remember, I said to you that this is before tax, so we must take tax implication into consideration. So now we have this as 16.67 before tax, and we need to deduct 28%. I just want to show this once again. This is a percentage. We need to deduct 28% on that, which we don't have to say minus 28%, but we can just say times this by 72%. Then after, we have to check how much will be our interest after tax has been deducted. 16.67 times 0.72. Then this will be 12.0024. So this is just 12%. You can just say 12%, no problem. Then after, we are looking for the present value of this financial instrument. How much is the value of this financial instrument now according to the market, meaning the interest of the market, not our interest rate. Then now let us do our calculations once again. As I said that I'm using sharp, 8 is my N, 12.0024 is the interest, 9,628,848 plus or minus is my PMT, and 89 or plus minus 89,156,000. That is my future value. Then I compute my PV, and my PV comes to 83,831,078. and there's 0.35 cents. Just want to make sure that I consider all the decimals. So now this is what to take into account. Let me just look at when I'm only taking 12%, because if I take 12%, the figure sometimes get to be a bit different, but it won't matter. 8 being N, 12 being I, 89,156,000 plus or minus future value, and 9,628,848 plus or minus PMT, and I compute my present value. It still gives, if I say 12% only, I just want to show you this. If I only write 12%, I don't consider the 0024. This is what I get. This is what I get. I get 83,841,110 or 261.31, and I'm doing this because maybe in a solution that you look at, it might be the amount without considering all these zeros for the 12%. So hence I'm showing. So this is at 12% exactly, not 12.0024. But the rounding off will definitely not be an issue as far as I know. So now we have considered the present value, calculated the PV of this financial instrument. Therefore, now we are done with our financial instrument calculations. So now we can go and we do what was required. What was required is to calculate the weighted average cost of capital. That's what we are required to do. So we are to calculate weighted average cost of capital. And weighted average cost of capital, we have capital structure. There's quite a number of columns, 1, 2, 3, 4, 5 columns. We have capital structure. Let me just use a different color. Blue seems to be a bit brighter. We have capital structure. And after capital structure, we have market values. We have market values. After market values, we have portion of the capital structure, and I prefer to call this the weight. I call this the weight. Then after, I have cost of capital. Cost of capital. Then after, I will have weighted average cost of capital. Let me just change the heading here so that you know this is the main focus. Weighted average cost of capital. So let me draw my lines in between. And this column will need quite a huge space. Then this one's not that much space. So now capital structure, we have ordinary. Second one, it is preference. Preference. Another one is debentures. Another one is long-term loan. Long-term loan. Yeah, long-term loan, very important because there's a short-term loan. Then our ordinary was 400 million. Ordinary stated capital according to the market was 400 million. So we take that as is, we paste where it's supposed to be. 400 million. 400 million. Then the second financial instrument, which is preference, is given or calculated according to the market as 27,500,000 rands. 27,500,000 rands. 27,500,000 rands. Debentures, we calculated them to be an amount of 16 million. There we have our debentures, 16,619,781. 16,619,781. 16,619,781. Please ignore the cents. I know I wrote that 30 cents. I just wanted to make sure that is, in terms of the calculation, is as accurate as it might appear in your calculator. Then after we have our long-term loan, which is just here, 83 million, and I prefer to stick with just the 12% without taking into consideration that 0024, because this is just a mere 12%. Now if you took everything, this will be what you will get, but all the answers at the end of the day will be the same. 83,841,261. Then after, now we need to draw a line and calculate the total of our market values. Calculate the total of our market values. 400 million plus 27,500,000 plus 16,619,781 plus 83,841,261. I get 50, very big amount. Let me just use a different color of the pen. It is 52,796,600 or 527,961,961 042. Uh, 527,961,042. So that is what I get as my total. Just recalculate it to affirm the accuracy of the numbers. 400 million plus 27,500,000 rands plus 16,619,781 plus 83,841,261. Yes, that is confirmed. 5,527,961,040. So now we need to say, now when we are calculating our weight will be 400 million. Divide this by the total 527,961,042. Then this will give me 75 times this by 100, 75.7, which we will be rounded off to 76%. So my weight is 76% for the first financial instrument. Second one, 27,500,000. Divide by the total value of the financial instrument or financial instruments, which is 527,961,042 times this by 100 this is 5%, meaning the weight for this financial instrument is 5% of the total weight of their financial instruments. The third one is 16,619,781 divided by 527,961,042. Then this gives me 3%, times it by 100 to confirm. So this is 3%. If you want now, you can just say 76 plus 5 plus 3 equals minus 100. Then you have 16% being the remainder. That is the easiest approach. Or else you can still say 83, 841, 261 divided by 527,961,042, and this will be times that by 100 is 15.8, which is 16%. So either way, if the last one left, you can just deduct from 100% the total to just get the accurate one. Now we go to the cost of capital. The cost of ordinary shares was 20%. There was the cost, it was 20%, and the cost of equity was 20%. So now we take that as it is, meaning, remember, cost is what we are currently paying on a specific financial instrument. In our preference, the cost is 10%. Yes, there we do have, according to the market, is 10%, because we are doing our work according to the market values. Remember that is the cost according to the market, and they say at a market value of and the cost of 20%. So the dividends payout is 11% here, but that is what we are paying, not according to the market. But similar preference shares are trading at 10%. So the cost according to the market is 10%. So we put the 10% of the market because the question instructed us to do so. Then we go to the next financial instrument and we look for the financial or the cost according to the market. And this is our debentures, which are currently trading at 11%. Remember, this is before tax. So now we need to multiply this by 72% because debentures attract tax. Please don't forget that debentures and loan attract tax. So when you record also the cost of capital, it must be after tax. So we have 11.11, which was already 8%, if you still remember that one. 7.99, which is 8%. So now for this financial instrument, we did calculate the 8% previously. Let me show you that 8%. Hope you still do remember. There we had the 7.9, which came to 8% rounding off. So that will be according to the market, the cost of capital according to the market, which is 8% after tax implication has been taken into consideration. So here we have 8%. Then now we look for the loan, and the loan had current trading interest at 16.67%, and we have already calculated this to be 12%, where we deducted 28%. So we are looking for 72% after 28% was deducted, and this gave us 12%, which was 12.0024. So now the cost of this financial instrument according to the market, again, it is 12%. Then after, we can multiply this, multiply this, multiply this, multiply this to get to the weighted average cost of capital. So 0.76 times by 20, it gives 15.2%. Then after, we have 0.05 times this by 10, it gives 0.5%. Then after, we have 0.003. Let me go to the previous one. 0.10 times by 5, or 0.5, 0.08 times this by 3 is 0.24%. It doesn't matter which one you choose to be a decimal. 0.12 times by 16, it is 1.92%. Then after we calculate the total, then the net will be the weighted average cost of capital. 1.92 plus 0.24 plus 0.5 plus 15.2, it gives me 17.86. It gives me 17.86%. So this is our weighted average cost of capital. And I hope you have mastered this, more especially where there is maturity. If any financial instrument has maturity date, you must know that where there is maturity date, you have to calculate using your financial calculator. And using your financial calculator, you'll need to have your N, your PMT, your future value, your interest. Then after you determine your PMT, here I had my 2 PMT, I chose one at 12%. Then you determine your PMT because there was a maturity date for the loan. But don't forget that your PMT must be after tax has been deducted. But this PMT is calculated according to the interest rate of the company, not the market. The only market interest rate that you take is the rate under the I line item. So be very mindful of that. Similarly with the debentures, there was a maturity date which was 5 years. Then you know that you must use your calculator. And future value, we had in this case to add 10% of the premium. Don't forget that there was the premium of 10%, which was added 1.10. So we have to say in the capital that will be paid in the future, we must add the 10%. And once again, this PMT is calculated at the interest rate of the company, not at the market interest rate, but we have to take into account the tax and multiply it by 72 to get it after tax was deducted. But this interest must be the interest of the market in order for us to determine our present value for this financial instrument. But for the preference, it's very easy for this one. You just calculate your preference dividends according to the company, which was based at 11%. Then you take that one, you divide it by the rate of the preference dividends or preference shares according to the market. You divide so that you get the capital according to the market. If dividends of 27.50 were paid, then that becomes your market values of your financial instruments. Yeah, it was just a bit of a summary. Then after you come, this table you need to memorize what goes in which column. Then the last column is the weighted average cost of capital. Now, in this case, we do not have to change the target structure. In some cases, you might need to change the target structure. Perhaps that will be another question that I will do perhaps later on. Thank you guys. God bless you. I hope you understood something out of this video. Thank you.